The $3 billion betrayal, why China's gold king just shorted silver, January 15th, 2026. Eric Sprott, the man who spent a decade telling the world silver was the most undervalued asset on Earth. The billionaire who built a $3 billion position backing that exact thesis, just executed the largest short position against silver futures in his fund's history. Not a hedge, not portfolio rebalancing, a deliberate bet against the very market he created. While financial media celebrated silver's breakout, Sprott was quietly positioning for collapse. But here's what they're not telling you. He didn't stop buying physical silver, he's shorting the paper while accumulating the metal. The same week, China locked down 70% of the world's silver refining capacity. The same month, COMEX inventories hit 28-year lows. The same moment, physical silver in Dubai started trading at $127, while COMEX showed $73, when the biggest believer stops believing in the price, but keeps believing in the metal. What does he know that you don't? Welcome to Daily Silver Crisis. If you've been watching markets long enough to remember when financial news actually explained things instead of just entertaining you, you're in the right place. We don't insult your intelligence with hype. We break down what's actually happening while others are still reading press releases. If that sounds like the kind of analysis you've been looking for, do me a favor. Hit that subscribe button. Not because I need the numbers, but because this information doesn't show up in your feed unless you tell the algorithm you want it. And before we go further, drop a comment and let me know. Where are you watching this from? Are you seeing these same supply chain disruptions in your part of the world? Because what's happening in silver markets right now isn't just happening in one country. It's global. And the people who understand that first are the ones who won't be caught off guard when contracts stop getting fulfilled at the prices everyone assumed were real. Let's get into it. There's an unwritten rule in the world of billionaire investors. When someone builds their entire reputation on a single thesis, when they stake billions of dollars on that thesis, when they spend years publicly defending that thesis in interviews, conferences, and shareholder letters, they don't suddenly bet against it. Not unless something fundamental has broken. Eric Sprott understood this rule better than anyone. For over a decade, he was silver's loudest institutional voice, not a trader chasing momentum, not a speculator playing price swings. A true believer who put $3 billion of actual capital behind his conviction. He built the Sprott Physical Silver Trust, the largest physically backed silver fund in the world. He gave interviews explaining why silver was the most undervalued strategic asset on the planet. He published research showing the supply deficit, the industrial demand growth, the monetary hedge properties. Everything pointed to the same conclusion. Silver was going higher, and he wasn't just talking, he was buying. Hundreds of millions of ounces, stored in vaults, physical metal, not paper contracts, not derivatives, real silver that could be touched, weighed, delivered. That was Eric Sprott's brand, that was his thesis, that was his legacy. Until January 2026, the financial filings showed something that made experienced market observers stop and read twice. Sprott's fund had taken a massive short position in silver futures, not a small hedge, not a tactical adjustment, a deliberate, substantial bet that silver prices, at least the prices shown on COMEX, were going to fall. The same man who had been buying physical silver for a decade was now shorting the paper market. At first, the financial media tried to explain it away. Portfolio rebalancing, they said. Risk management in volatile markets, the analysts wrote. Profit-taking after recent gains, the headlines suggested. But anyone who had followed Sprott's career knew better. This wasn't portfolio management. This was something else entirely. Because here's what made the situation truly bizarre. While Sprott was shorting silver futures, his physical silver trust kept buying. The same week his fund filed the short position, the Sprott Physical Silver Trust announced another purchase of physical bullion. He was betting against the price while accumulating the metal. For retail investors watching this unfold, it looked like madness. For institutional players, it looked like something far more concerning. It looked like a man who no longer trusted the market itself, not the asset, the market, the pricing mechanism, the entire structure that was supposed to reflect supply and demand. Think about what that means. Sprott wasn't saying silver was worthless. He wasn't saying the fundamentals had changed. He wasn't saying demand was collapsing or supply was surging. He was saying the number on the screen, the price that COMEX reported every day, was becoming disconnected from reality. And when a billionaire who built his reputation on understanding a market better than anyone else starts treating the price as fiction while treating the physical metal as fact, that's not a trading signal. That's a structural warning. The business community needed to understand what this meant. Not for investment purposes, not for speculation, but for operational planning. Because silver isn't just a precious metal that investors buy. It's a critical industrial input. Solar panels need it. Electric vehicles need it. Electronics need it. Medical equipment needs it. Military systems need it. if the pricing mechanism for that material was breaking down, if the largest institutional expert in that market was positioning for that breakdown, then every business, every manufacturer, every supply chain manager who depended on stable silver pricing was operating on assumptions that might no longer be valid. Sprott's contradiction wasn't a mystery to solve, it was a warning to decode. And the people who decoded it first would be the ones who weren't blindsided when the gap between paper prices and physical reality became too wide to ignore. The question wasn't why Sprott shorted silver. The question was what he saw coming, that the rest of the market hadn't priced in yet. There's a moment in every market crisis when the mechanics stop making sense, when the institutions that are supposed to maintain order start creating chaos instead. December 2025 looked normal on the surface. Silver prices were climbing steadily. Industrial demand was strong. Investment interest was growing. But beneath that surface, something was quietly breaking. The COMEX silver vaults were emptying, not slowly, rapidly. Registered silver stocks, the metal actually available for delivery to contract holders, had fallen to levels not seen since 1998, below 40 million ounces. To put that in perspective, global industrial demand for silver runs about 600 million ounces per year. That's roughly 50 million ounces per month. The entire COMEX registered inventory represented barely 60 days of global industrial consumption. For a market that's supposed to be the world's price-setting mechanism, that's not a comfortable margin. That's a problem. But here's where it gets interesting. When inventories get tight in a functioning market, prices rise to attract more supply. That's basic economics. Supply gets scarce. Price goes up. Higher prices bring more metal to market. Balance restores. That's how it's supposed to work. That's not what happened. Instead of letting prices reflect the inventory crisis, COMEX did something remarkable. They changed the rules. January 3rd, 2026, first margin requirement increase. Traders who wanted to hold silver futures contracts suddenly needed to post 15% more capital. January 10th, second increase, another 12% on top of the first. January 17th, third increase, another 13%. In 3 weeks, the amount of money required to hold a silver futures position had increased by 40%. The fastest series of margin hikes since the Hunt Brothers crisis in 1980. Now, COMEX claimed this was about managing volatility, about ensuring market stability. Standard corporate language. But let's translate what that actually means in operational terms. Margin requirements aren't about safety, they're about capital efficiency. When you raise margins by 40% in 3 weeks, you're not protecting the market, you're forcing participants out of it. Here's the mechanism. Most futures traders operate on leverage. They don't have unlimited capital sitting idle. They calculate position sizes based on margin requirements. When those requirements suddenly jump 40%, traders face a choice: post more capital immediately, or close positions. Most can't post more capital on 3 days' notice, so they close positions. They sell. And when enough traders are forced to sell at the same time, it creates a cascade. Selling triggers more margin calls. More margin calls trigger more selling. Prices fall. Falling prices trigger stop-loss orders. Stop-losses trigger more selling. The cycle feeds itself. This wasn't market volatility. This was engineered liquidation. And while Western funds were being forced out of positions, 3 types of buyers were absorbing everything being sold: China's sovereign commodities reserve, Dubai-based physical dealers, and Eric Sprott's physical trusts. Notice the pattern. Every entity with actual delivery capability, every player who could take physical possession of metal, was buying, while everyone trading paper contracts was being systematically squeezed out. The data told a story that mainstream financial media completely missed. COMEX open interest, the number of active futures contracts, collapsed by 35% in 3 weeks. Massive liquidation, exactly what you'd expect when margins spike and traders are forced out. But here's what didn't make sense. Physical silver premiums in Asia were exploding. In Dubai, physical silver bars were trading at $127 per ounce. On COMEX, the spot price showed $73, a 70% gap. 70%. That's not a premium. That's a completely different market. When paper and physical prices diverge by that magnitude, one of 2 things is happening. Either the paper price is fake, or the physical price is fake. And when the people with the ability to actually deliver metal are paying the higher price, while the people trading contracts are getting margin called out at the lower price, which one do you think is real? This is what Eric Sprott saw. This is what his short position was betting on. He wasn't betting against silver. He was betting against COMEX's ability to function as a legitimate price discovery mechanism. He was shorting the structural lie, the lie that paper contracts and physical metal were the same thing, the lie that COMEX prices reflected actual supply and demand, the lie that you could trade a contract for months and then demand delivery at the paper price. For business leaders, this wasn't an abstract market theory. This was an operational crisis in the making, because every contract written with COMEX spot plus premium pricing, every hedge based on COMEX futures, every supply agreement assuming COMEX represented real prices, was now exposed to basis risk that could swing 50% to 70%. That's not a hedging problem, that's a contract validity problem, and Sprott positioned for it 6 weeks before it became obvious. The announcement came through official channels on January 15, 2026. China's Ministry of Commerce issued what they called temporary export licensing requirements for refined silver. Corporate language, bureaucratic phrasing, the kind of statement that sounds boring enough that most analysts scroll past it. But 3 words in that announcement changed everything. Refined silver exports. Not mined silver, not raw ore, refined silver. And that distinction matters more than most people realize, because China doesn't dominate silver mining. They produce about 16% of the world's mined silver, respectable but not dominant. Mexico mines more, Peru mines more, China ranks 3rd or 4th depending on the year. So when the announcement hit, Western analysts shrugged it off. Limited impact, they said. China isn't even the top producer, the reports noted. Temporary trade friction, the headlines dismissed. They were looking at the wrong number. China doesn't need to mine the most silver, because they refine 70% of it. 70% of all silver refined globally goes through Chinese processing facilities. Raw ore gets mined in Mexico, Peru, Australia, Poland, gets shipped to China, gets processed into pure silver bars, then gets shipped back out to manufacturers worldwide. That's how the global supply chain evolved over 30 years. Western countries chased cost efficiency. Environmental regulations made refining expensive in Europe and North America. Labor costs were higher. Energy costs were higher. So refining capacity gradually shifted east, to China, where costs were lower, where regulations were different, where the infrastructure could be built quickly and cheaply. It made perfect economic sense at the time. But economic efficiency created strategic vulnerability, and China understood that vulnerability better than anyone. Here's what the temporary licensing requirements actually meant in practice. Chinese refineries could still process silver, but export approvals would now go through government review. Priority would be given to domestic industrial needs. Translation. Chinese solar panel manufacturers get first access. Chinese EV battery producers get second access. Chinese electronics manufacturers get third access. Everyone else gets what's left, if anything is left. This wasn't retaliation for tariffs. This wasn't a negotiating tactic. This was strategic resource positioning, because China looked at the global landscape and saw an opportunity. The world is trying to transition to green energy. Solar panels need silver, lots of it. About 20 grams per panel. Doesn't sound like much, until you multiply it by billions of panels. Electric vehicles need silver. Every EV uses roughly twice as much silver as a traditional car. For electrical contacts, circuit boards, battery management systems, the green energy transition isn't just about lithium and cobalt. It's about silver too. And China controls 70% of the refining. Not the mining, the refining. That's the choke point. Because you can mine all the silver ore you want, but if you can't refine it into pure metal, you can't manufacture with it. And building refining capacity takes time, not months. Years. 5 to 7 years to build a modern refining facility from scratch. Longer if you're dealing with environmental permits in Western countries. So when China announced temporary export restrictions, they weren't being temporary. They were locking in permanent strategic advantage. Because once those Chinese refineries redirect capacity to domestic manufacturers, once Chinese solar companies secure guaranteed silver supply, once Chinese EV makers lock in processing priority, that capacity doesn't come back to export markets. Why would it? Western analysts kept saying temporary. Eric Sprott understood it was permanent, and he positioned accordingly. His short wasn't against silver's value. It was against the assumption that Western markets would continue having access to refined silver at prices that ignored this new reality. COMEX was still pricing silver as if global supply chains functioned normally, as if refineries would process ore and ship metal wherever the price was highest, as if markets were free and open and operating on pure economics. But that world ended on January 15th. The new world had strategic resource allocation, export controls, domestic priority, and a 70% refining choke point controlled by one country. Now stack the numbers. 70% of refining capacity redirected to domestic use, plus COMEX registered inventory at 40 million ounces, plus an existing 800 million ounce annual supply deficit that was already running before the restrictions. What do you get? A 3 to 6 month window before Western industrial consumers stop getting price increases and start getting delivery failures. Not higher prices, no delivery. At any price. That's not a commodity market anymore. That's a strategic material under allocation. And every manufacturer, every supply chain manager, every business leader who depended on reliable silver supply was about to find out what happens when efficiency becomes fragility. Sprott saw it coming. That's why he shorted the paper, because COMEX couldn't deliver what China wouldn't refine. The contracts promised metal, but the metal wasn't flowing to those markets anymore. And when the contract can't be fulfilled, the price on the contract stops meaning anything. That was the trade, not against silver, against the illusion that paper contracts still represented reality. The headlines kept talking about silver prices, up 5%, down 3%, volatility, trading ranges, chart patterns, all noise. Because the real story wasn't about price anymore. It was about something far more fundamental. The market had split in two, and most people hadn't noticed yet. On one side, COMEX showed silver at $73 per ounce, official price, quoted everywhere, used in contracts, referenced in supply agreements. The number everyone assumed was real. On the other side, physical silver in Dubai traded at $120 per ounce, not a typo, not a temporary spike, a sustained 70% premium, for the same metal, in the same world, at the same time, when two prices exist for the same asset, and they diverge by 70%. One of them is lying. The question is which one? And the answer is simpler than most people think. Follow the metal. Who's buying physical at 127s? Industrial manufacturers who need actual delivery. Sovereign wealth funds taking possession, Middle Eastern dealers with vault capacity, Eric Sprott's physical trusts, people who need real silver, not contracts, not paper promises, actual metal they can touch. Who's trading at $73? Hedge funds trading contracts, speculators playing price momentum, traders who never intend to take delivery, people dealing in paper, not metal, promises. When the people who need the actual product are paying $127, and the people trading paper are paying $73, the $127 is the real price. The $73 is the fiction. But here's why that matters beyond investment portfolios. Most businesses don't think about commodity markets. They think about supplier contracts, purchase orders, pricing agreements, and many of those agreements reference COMEX prices. COMEX spot plus 15% premium, standard contract language, used for decades, worked fine when COMEX prices actually reflected physical market reality. But what happens when that breaks down? Your supplier quotes you COMEX plus 15%. You see COMEX at 73s, you calculate $84 per ounce delivered, you budget accordingly, you sign the contract. Then your supplier tries to source the metal. Physical market price is 120 safarans. Your contract says $84. Your supplier has two choices: lose money fulfilling your contract or fail to deliver. Most will choose the second option. This isn't theory. This is already happening in supply chains right now. Solar panel manufacturers placing orders, then getting told delays. Electronics companies with confirmed delivery dates, suddenly hearing supply constraints. Medical equipment producers with long-term contracts, receiving force majeure notices. The language is always corporate, always polite, always technical. But the translation is simple. We can't get the metal at the price we promised you, because the price you're looking at isn't real. For business leaders, this creates a problem that has nothing to do with speculation. It's an operational risk assessment. If your manufacturing process depends on silver inputs, if your product margins are calculated based on COMEX pricing, if your supplier contracts assume COMEX plus premium, you're operating on assumptions that may no longer be valid. Not might be invalid someday, are invalid right now. This is what Eric Sprott understood 6 weeks early, not because he's smarter than everyone else, but because he had access to supply chain intelligence that most people don't see. Billionaires with direct commodity market exposure don't trade based on chart patterns. They trade based on operational data, phone calls from refineries, conversations with vault operators, intelligence from shipping companies, information that shows up in positioning, weeks before it shows up in headlines. When Sprott shorted COMEX silver while buying physical, he wasn't making a price prediction. He was responding to a structural break that he could see, but that wasn't reflected in official prices yet. The $3 billion betrayal wasn't a betrayal at all. It was a billionaire refusing to pretend, refusing to act as if paper contracts and physical metal were still the same thing, refusing to participate in a pricing mechanism that had disconnected from reality. For the business community watching this unfold, the lesson isn't about silver investment. It's about operational assumptions. When a critical industrial input shows 70% divergence between paper and physical prices, when the largest institutional expert in that market positions for that divergence, when strategic competitors lock supply chains while paper markets pretend everything is normal, the pricing mechanism has failed, and business decisions made assuming that mechanism still works are now based on fiction, not future fiction, current fiction. The question isn't whether to buy silver. The question is whether your costs, your contracts, your strategic plans are built on price discovery that no longer functions. That's not an investment thesis. That's a risk assessment. And the companies conducting that assessment now won't be the ones scrambling when suppliers stop delivering at contract prices, not because prices went up, but because the prices everyone was looking at were never real in the first place.